Okay, what I'd like to do is just kind of show you how we close out positions because this is one of the things that is so important. It's important for you to understand the principles of what we're trying to do rather than, learning techniques that you just do it like a robot. You don't want to be a robot. You really want to be able to, take a look at these techniques and do them as a principle. So in other words, let's take our SPY position, which is an iron condor. Now we're very close to our maximum profit on this. I mean, if we held it to expiration, which is only a few days away, we'd make $500. But price is always a risk in the last week of expiration because it can move either way. And yes, we do have a lot of room to move, but if we get large price movements, it's going to hurt one side of our position. Now think about this for a second. If we believe, and I think that we'll probably be up on the markets this week. Now, whether we're up or down, it doesn't really matter, but let's say that we think there's more upside potential to the market. What is the only thing holding this position back? Well, it's our short call. If we have in our current position, our position that we had, we were long the 145 calls and short the 143 calls. When we sold the 143 calls, you can take a look right down here, we sold them at 92 cents. Now if we take off this little lockbox here and change it to green, you can see that the current price is 8 cents. So we made a profit because we were short those calls from 92 cents down to 8 cents. We've made, 84 cents in profit. If we believe that the market is going to go up, why not take those calls out? Because those short calls will work against us if the market continues to go up. And what does that do for our position? Well, basically what it does for our position is give us a free call. The 143 calls we took that whether we're short we took out, we still have the long 145 calls, and they're only trading for 2 cents right now. So we're not going to make very much money on that if we just take them out, are we? No. But if we leave them there, look what it does to our profit picture. If we continue to stay where we are, or even if we go down quite a bit, I'll just spread this out a little bit for you. We still have another $55 in profit that we can grab in this position. However, look at our white line here. That's what would happen if all of a sudden we went up 500-600 points on the Dow. We could get into a position where we actually have, this 145 call down here that's only trading for 2 cents is basically a free call. We paid for already by our short position, and we made a profit on that. So basically what we're doing is just taking a long call here, our remaining position, and just keeping it because it's only worth 2 cents. And since we're long that call, it really doesn't hurt. It can't go much farther down because it's only 2 cents, right? So we might as well keep the position. You don't have to close this position out because right now the mark, as you can see, is only 2 cents. If it just goes up, we just continue to make more money. And if it goes down, well, we've only lost 2 cents, so that's no big deal. So basically it gives us a long call. So what we want to do is when we pare down, when we get towards expiration week, what we'd like to do is be able to sell out our short options, because those are the ones that could go against us. Now the long options, it depends. It depends on what the market conditions are. I think the market is going to continue to go up from here. If that's the case, we have a free long call. So that's why we're going to keep it. Anyway, that's just a very, very short tip on closing out positions. If the market you feel is going in the direction of the short calls that you have or the short puts that you have, and you're very close to expiration, and in this case we sold them at 92 cents and the current market is only 9 cents. So what we did was we just closed those out at 9 cents, and we've made, we made the majority of our profits. There isn't much profit left at 9 cents. There's only about $40 left. So we close those out. That gave us a long call at the 45s, and basically that's a free call. If the market continues to move up, we're going to make additional very free profits. And giving you a little bit of an insight on the principles of what we're talking about. Now, the same thing applies on the downside. If you thought the market was going to move down from this position, then you might want to take a look at, for example, these May 132 puts. We sold them at 92 cents. The current market is 7 cents. We have the majority of our profits in there already. Another 7 cents is only about $35 in profit. However, if we thought the market was going to move down, we should sell those puts out. But I think we're going to continue to move up higher, so we can capture that additional 7 cents. One thing about Thinkorswim, which I really, really like, is that any option that's under 5 cents or 5 cents and under is commission free to close out the position. I mean, that's not a huge that's not something that we should consider if the price is moving against us and we really want to get out of a position. But I think the market is going to continue to move up, so we don't really have to close out these puts, and it'll save us some commissions if we don't have to close them out and we let them expire worthless. Just a point to remember. Okay, guys, trade with confidence.